Biryani, everybody's favorite comfort food. Think about what it's made of. Rice, obviously, the veg or the non-veg component. And I know that some of you will want to troll me about this, but bear with me. And masala. Now, think of the type of biryani that you like to eat. There's Hyderabadi dum biryani, there's Lucknowi biryani, also known as Avdi biryani, there's Kolkata biryani, there's Malabari biryani. And they've all got similar ingredients, but the constitution is different. And depending on the amount of spice that you like, you'll prefer one or the other. Now, think about biryani as your portfolio. The rice is the base, the fixed income. And the masala is the equity. Add too much masala and it's going to be too spicy. That is, unless you like that extra spice. Too much rice and it won't taste good. It's going to be too bland. And of course, the veg and the non-veg component can be the gold. You can't have too much of that either, or it won't be biryani anymore. Let's talk about asset allocation today. And we've got Vijai Mantri, investment expert, joining me in studio. Vijay, how do you like my biryani example?
It was a very interesting and very different take. and food, it's very easy to connect through food.
It is, isn't it? Yeah. And a lot of people have tried their hand at making biryani in some form or the other, even if it's not Lucknowi biryani or Kolkata biryani, right?
Yes.
But having said that, you need to have balance, right? And that balance needs to be appropriate for you. How do you find the balance that is appropriate for you?
See, in life, we would like to have a silver bullet answer to complicated questions. So what is asset allocation? A traditional way to look at is 100 minus your age, one should need to put money into equities. So now let's look at first at equity itself. When we look at equity, does all equity behave similarly?
No.
There's a large cap, there's a mid cap, a small cap, then there's a momentum, then there's a thematic, and then you add international as well, which was not there perhaps when the asset allocation started appearing 30, 40 years back. And they behave very, very differently. And last year was a very good illustration wherein Nifty was almost flat and Colombia delivered 100% return, South Korea delivered 100% return.
So Brazil was some 40+%.
40%. There are many countries which deliver more than 50% return. And there are many countries which didn't deliver at all. So first is, when you look at equity, which part of the equity you are looking at? Second thing, when you look at fixed income, now it's very, very interesting. For ages, Japan had a zero interest rate. Now suppose somebody allocated money at zero interest rate and interest rates are rising. And somebody is long bond, 10 year, 20 year, 30 year.
They're losing money.
They're losing money. Same thing in USA, same thing in UK. People have seen for 20 years low interest rates. Now suddenly interest rates start going up. Then your allocation into debt. Now even within the debt, you need to figure out, it's just not the question of just debt and equity. Within these categories, it is very important to look at how do you put a bucket strategy in place even for the fixed income. Then on the top of it, you had a real estate, you also have fixed income, you have a precious metal, and now you have bitcoins and all kind of thing. So asset allocation from a traditional angle is not the right metrics to look at. In the changing investment scenario, it is very important to have a relook the way we look at asset allocation. Just don't look at 20% equity, 30% not like that. Every individual need to figure out what best suits them, and we can discuss that through a couple of illustrations.
And we will. I want to start at a point where I would not normally have started. And I want to start with gold because, and you must have seen the latest data from the mutual fund industry, where in the month of January, you had over 24,000 crore rupees that got poured into gold ETFs, a further 15,000 crore rupees that poured into other ETFs, which is primarily silver ETFs, and close to 10,500 crore rupees that poured into multi-asset funds, which is partly commodities and gold. There is this frenzy that is going behind gold and silver, and that is evident in the fact that if you put all of these three buckets together, then you're talking about 40, 45, 50,000 crore rupees that has gone towards this one asset class. And if you look at half of that, or less than half of that, 24,000 crore rupees cumulatively has gone towards active equity. What does that tell you?
So it is very simple that people chase return everywhere. You know, if what is a better thing to look at is that whenever you look at investment performance of asset category, the current investment performance will tell you what happened in past, not necessarily what will happen in future. So whenever you need to look at an asset category, figure out when it delivered the best return. What was the starting point? And invariably, the starting point of future performance is that the current performance has not been very good. Look at gold 3 years back or silver 2-3 years back. If you looked at silver 2 years back or 3 years back, it looked very ugly. Nobody wanted to touch it.
Yeah, from 2012-13 to 2022.
22. So that was perhaps the best time to look at investing, but nobody would look. Let's look at international investing for argument's sake. If you were sitting, you and me were sitting in 2025, beginning of 2025, Korea was negative. And in 2025, Korea delivered 80%, 90% return. So what is happening right now is what happened normally, chasing return. You and me were sitting 2 years back, I remember around 1.5 or 2 years back, and we discussed about a small cap. And you know, the question were coming from people that I'm a 10-year-old, I'm 10-year investor, I'm investing for the long term. What's wrong in continuing my SIP into mid and small cap?
Yeah.
So this is a typical challenge which every investor faces.
And there was froth at the time. There was quite a considerable amount of froth.
So just I look at very simple metrics. When I look at equity, when I look at precious metal, I look at very simple metrics. And you can follow that matrix. No method can be 100% right, but the odds are much better in your favor. So if you look at Indian equity markets, say for instance, India GDP expanded 12 to 14%.
Sure.
Earning of Nifty Sensex expanded 12 to 14%. If 10-year returns are 10 to 14%, nothing to worry.
Sure.
That's why we are saying Nifty, no problem. When we spoke at that time, 1.5, 2 years back, the 10-year return on a small cap was 20% CAGR. So that is not sustainable because your earning can't grow 20% per annum, because if GDP is expanding 12 to 13%, 10-year you deliver 20% return. So even you are underperforming past, and now it is catching up. All the catching ups are behind it. So for instance, if you look at gold, in 2017, the 10-year, no, 2011, so in November 2011, the 10-year CAGR of gold was 17 to 19%.
Right.
We have hit the same number here, and after the gold has not delivered return. Okay, and every time when asset category does well, there are always reason given that why it will continue to do well. So my suggestion to anybody who made big money into precious metal, this is the time to start trimming. Take your excess return out and put somewhere else.
For the sake of argument, let me make a few arguments in favor of gold, just so that we're debating this, and it can be a philosophical debate as well. There are a few things that have panned out over the course of the last year, year and a half, that have caused people to change the way that they view dollar as a safe haven, right? So we've seen these themes of de-dollarization play through. There were a few headlines just earlier in the week of, in China, certain institutions being asked to trim a dollar bond exposure. So from that perspective, if global central banks are holding less dollar, they are gravitating towards the next best store of value, which is seen as gold, and in certain cases silver, but to a much lower extent. So if this paradigm shift has taken place, and no one's saying that the fiat currency is going to go away, no one's saying that dollar is going to go out of the window, but if on the margin, people stop buying as much dollar as they did in the past, there's a debt problem in the US. More and more buying in gold will likely continue to take place. Is there not an argument to have a sizable chunk of gold in your portfolio?
No, most Indians do have in any case.
Yeah.
Okay, it's just the ETF we are talking about.
I'm talking about digital gold.
So most of already have in physical form, but digital gold people are buying. But do remember that whenever these kind of return comes, the future doesn't look very good. So the current returns are nothing compared to what we witnessed from 1970 to 1980.
Sure.
In 1970, the dollar was $35. It went up to $850 by 1980. So in a 10-year period, both in dollar and INR, gold delivered 22 to 24 time gain in absolute term.
Wow.
In 1970 to 1980. Now, why it happened? Why it happened? Because from 1935, the gold prices was $35. From $35 till 1970, it remained at $35. So a asset category which remained flat for 35 years, and then it suddenly shot up and caught
Because
up.
that was when it was the gold reserve,
Gold
right?
reserve, and then, you know, what US did in 1970, everybody knows what they did. Similarly, if you see what happened right now is they refuse to almost honor the Russian
Yeah.
obligation. So from here, even gold can go up 20%, even 30%, even 50%. But in business of investing, you look at what are the odds.
Sure.
You should always play odds. You can't play what exactly is going to happen because nobody knows what is going to happen. So when you have an asset category which has delivered you 15, 18% CAGR, a asset category which doesn't have earning, it is just that people are fearful of what will happen through AI, what is happening to USA, what is happening to dollar, and definitely dollar's best days perhaps are behind. So that is a, and a lot of central banks are actually now looking at beyond dollar. But just please keep in mind that whenever these kind of big tectonic shift happen, after that asset category remain very flat. And just remember, once upon a time, silver was used in a photography as well.
Sure.
When the price of a product, a particular commodity start going up to a level, today the silver is costing you 5 times more than its cost of production.
Yeah, so people are already looking for alternatives to silver in industrial use.
The world is self-correcting.
Yeah.
Alternative will emerge.
Sure.
Okay, and people will look at something else. So whenever you see these kind of return in any asset category, whatever it may be, it doesn't sustain.
It doesn't sustain. So therefore, but okay, to the point, and we'll complete this portion on gold very quickly, and then we'll move to equity and fixed income as well. But to the point that some people have made to say that traditionally it was said you have 5 to 10% allocation. The argument can be made to have a slightly higher allocation to gold purely on the basis of the fact that likely we are seeing paradigm shifts take place, at least in this moment. If you're at 30%, nobody's arguing, cut it down to 20 or 15%. If you have the risk appetite, then keep it to 20%. Is that the wrong argument to make?
See, this argument is made purely on the basis of recency bias.
Sure.
Recently, we had a great performance. So whenever we used to talk about gold, nobody used to talk about beyond gold.
Sure.
Today we're talking about copper.
Yeah.
Today we're also talking about silver. Silver perhaps talking more about silver.
Yeah, palladium, platinum.
All kind of commodities we are talking about because people are talking about EV, rare minerals.
Sure.
All these things we have discussed many times, you know. So I don't think so. My argument is very simple. You look at predictability of investment performance, what will happen in future. Which asset category is the most predictable?
Equity.
Why? Because it has earning. And India is the dinosaur of world. We're going to lead world GDP expansion. And if you want to make money in future, then you need to look at which asset categories mostly ignored today.
Sure.
And equities mostly ignore asset category from international perspective as
That
well.
is the perfect opportunity for us to delve into equity strategy. So, okay, but just to complete that point, you've said that it does not make sense to go to 20%. What is appropriate for you?
I think 5 to 15% is the most appropriate thing.
Gold plus silver.
Gold plus silver, but I'm telling you, the best time to own gold when gold 10-year return is single digit.
Okay.
Not at these levels.
And that
at
time is
these
fast.
level, one need to look at trimming their portfolio. Okay.
Yeah.
You look at period when it didn't deliver the great investment performance. So it need to be seen. So whenever somebody look at asset allocation, don't blindly follow asset allocation.
Sure.
You also need to be sensitive to one part is liquidity.
Yeah.
How liquid is your portfolio? Luckily, gold is very liquid, but other asset category may not be that liquid. Second thing, what kind of maximum drawdown you could witness?
Yeah.
You could tolerate on a suppose you invested in silver just 10, 15 days back and the silver dropped 30%.
Yeah.
Will you accept that kind of volatility on your portfolio?
Yeah, that's an important question to ask.
Yeah.
And people don't study standard deviation in commodities, but actually the fact is that the standard deviation on silver is extremely high, perhaps higher than certain small cap portfolios.
No, much, much higher.
Yeah.
We haven't seen a single asset category falling 30% in a single day.
Yeah.
So
there you go. You should be able to stomach that volatility. But having said that, let's move to equity. And rightly so, it's an important point to be talking about this because you've seen classic cases of recency bias play out, right? Automatically, the conversations at dinner tables or at parties has shifted from, hey, you know what, my equity portfolio has gotten 23% returns over 4 years. What about yours? To how much silver do you have? So therefore, let's talk about equity and what your advice would be. Because let's face it, a lot of people who are in their 20s and their 30s right now, it's the opportune moment to accumulate these equity assets that are going to hold you in good stead 5, 10, 15, 20 years down the line.
So let's go back to the basic. What is investment?
Yeah.
Investment is actually postponement of current consumption. And the need for future consumption can come at any point of time. And what you want to protect yourself against, the biggest concern you should have is how I protect myself against inflation, because that is, and inflation is not what government is telling you.
Yeah.
1%, 2%, because it is onion and tomatoes. Real inflation is OTT, travel, which is like 7, 8%.
And that changes this soon.
15th, I think 15th,
12th,
Feb,
12th,
12th, whatever
Feb,
the
yeah.
date. So they will change it. So the real question is you need to look at, and very interestingly, Alex, today consumption is happening without we being aware about it. Consumption is no longer we are making active choice. Consumption is auto debit, surge prices. Consumption is, automatic money getting deducted from your bank account.
It's credit card swipes.
Credit card, you have OTT subscription, you have a digital payment which you have already lined up. YouTube subscription. I'm just taking the various thing. You are not even aware that is being hit. Just you get a SMS that something has hit your account. So this is the way the consumption is happening. 5 years back, suppose 11 o'clock you felt hungry, you won't do nothing. Today you will go and buy something. So various things are happening right now. So these things are actually eating your corpus. How do you protect yourself against those things?
You front load it.
You look at who is taking money out of me. Can I become the owner of that business?
Interesting.
So this is the way you should look at, plain and simple.
Is it that simple though?
It is as simple as that. What is the meaning of equity? हिंदी में equity को अंश बोलते हैं. अंश का मतलब होता है हिस्सा. Basically, you are becoming a part owner of the business. So just look at this way. You look at your consumption pattern from morning till night, what you're consuming. Out of that, you take out all listed companies.
Yeah.
And you invest in these listed companies in the proportion of your household consumption. You will do great.
Okay, but what if somebody does not have the ability to track it on an ongoing basis? And here we're talking about either stock picking or you're talking about mutual fund investments, right? And let's face it, most people are better geared towards mutual fund investments because they can't deal with a sudden 5% drop in an Eternal or Swiggy, which happened earlier this week. And they look at it and say, oh, what happened? Some of these companies that they would have to invest in are new age companies. They're relatively volatile. And maybe in some cases, the argument has been made that the valuations are a little stretched. And so if you want to not get into all those kind of things, and you're talking about equity investing through mutual funds, how do you ensure that you're appropriately exposed to what you need to?
So I think you need to look at 5 to 10 good quality fund houses and take exposure with these fund houses. You look at equities and how the world changes. Low volatility, high quality company used to do much better. Today, 2-3 years back, low volatility and high quality companies were IT and FMCG.
Sure.
Today, they are no longer low volatility company. This is the way underlying economy changes. If you look at profit pool of listed company in 2005, 10, 20 and 25, the way things changed dramatically. At the COVID time, the weightage of IT company in the profit pool was 20% of total profit. Today it's dropped to 8%.
Yeah.
We have seen similar kind of trend. So it is not possible for a normal investor to track these micro trend or macro trend. It is better to give a job to a professional fund manager.
Right.
In India, we have a 30-year track record. Average return has been 15 to 16% compounded. What more you want?
What more do you want? So then, from that perspective, you already talked about 5 to 15% towards gold. What is equity allocation?
So the way I look at equity allocation, the way I look at asset allocation is number one, you need to figure out how predictable are your earning. Because if you want to continue your investment, then you should have more predictable earning. The more predictable earning you have, better to have a longer term portfolio. Second, you need to figure out when do you need the money. Suppose you need money 6 months later, 1 year later, 2 year, 3 year, 5 year, 10 year, 20 year. Then figure out which asset category have the highest probability of delivering inflation beating return and do allocation accordingly. Third, you need to figure out what are the liquidity needs I have. Asset category where you can't take money out immediately, even is a great investment, but is not liquid, then you need to be mindful of how much money you need to put in
Real
there.
estate.
Third, drawdowns. You also need to be mindful how much drawdown you can tolerate on your portfolio. It is great to talk about equity or gold or silver doing fantastic, delivering fantastic return, but are you willing to take 20%, 30% drawdown? So the way I look at asset allocation, anything between 3 to 5 year of your cash needs, that need to go into fixed income only, and there you don't need to chase any return. That don't do return chasing.
Capital protection.
And go into high quality. We'll come to that as well. It's very interesting. I'll talk about that. Why in India you need to look beyond AA. Then
On the downside, you're saying?
no, I'll talk about.
Okay.
Beyond 3 to 5 year, you need to look out, start investing into hybrid fund, multi-asset fund, and then
Beyond
7
5
year
years.
plus, you look at investing in equity. But put that much money into equity on which you can tolerate 20% drawdown. And 20% drawdown tolerance is not theoretically. When it actually happened to you, what was your reaction?
Yeah.
Now let's look at something very interesting happening on the fixed income side.
Yes.
If you look at Indian fixed income side, the AA plus category, AAA, is completely crowded by insurance companies, banks, and government. So there the interest rates are always artificially low, 6.5% to 7%.
Right.
You need to create ability where you go beyond AA, because insurance company can't invest in AA plus, below AA, and a lot of trusts can't invest. There lies the big opportunity, 8%, 9%, 11%. That market is not yet developed in India, but that is a market one need to look at.
So it's an important point that you raise, and if I look at mutual funds, they've been burnt by the IL&FS crisis, right? And they have the so-called credit risk funds where I think you can see maybe 1 or 2 papers which are single A. Most papers are AA plus. And quite a few are AA, right? They don't go below that. And so therefore what you're talking about, they don't offer you that kind of credit risk.
Mutual fund is a wrong way to look at credit at all, because the way the mutual fund has been constructed, because in mutual fund, the asset size where you are investing, but the liability side can go any day.
Yeah.
It doesn't have CRR, it doesn't have SLR, it doesn't
Sure.
have any protection.
So
mutual fund is a wrong way to look at credit going beyond.
how
You
do
need to look, you need to go beyond. And why mutual fund was preferred for that option? Because you had a preferable tax treatment. Now that has disappeared.
So you look at individual bonds. you're
You
saying.
need to look at beyond that, and mutual fund can't have these because these are not very liquid. Okay, so you need to look at quality companies in that basket. And today the options are available, 7.5% to 12%, depend on whether you do through AI, whether you do through bonds, but you have to be very careful in how do you select and create a portfolio. But today, if you ask me, the investor need to figure out how to play fixed income.
So, okay, let me spend a couple of minutes on this because it's important. And you're saying that you can invest in the bonds of companies, preferably in companies that you know, and preferably companies that you understand, relatively speaking, because in a sense, even if this is a fixed income product, there is an element of equity risk involved as well, right? Because if a company's business is not doing particularly well and it is raising funds as a single A rated paper, if it goes bust, ultimately equity, so you lose everything.
No, it is not an equity kind of. Actually, it is worse than equity.
Exactly.
Because you can lose 100% capital without any upside.
Exactly.
Yeah.
So therefore, my point to you is, what is the advice that you have for somebody who's listening to this and saying, I want to invest in the paper of or bonds of a company?
So you need to look at, for instance, as I told you, the gap between AA and A is 2 to 2.5%.
Nice.
Because AA is insurance, banks, trust, chasing them. Just go beyond that. Look at A plus A. The gap could be anything between 1.5 to 2%, and sometimes 2.5%. Look at great promoter, great companies. You have options available, but you need professional help to identify those options.
And just so we drive home the point on asset allocation within your fixed income strategy, what percentage are you looking at with regard to this strategy? Because this is your credit and relatively riskier strategy, right?
So you need to look out. You need to look where you would at least 5% to 20% of your fixed income portfolio should be marketed in these kind of things, put into these kind of things. But more importantly, the way you diversify in equities, like one mutual fund give you 20, 30 stocks. Similarly, just don't buy a bond of a single company. Create a diversification as a free meal. One of the best way to counter any credit default risk is diversify across sector, diversify across promoters, have 20 to 30 decent bond in your portfolio. That is now today's possible through a different platforms.
Yeah, and you can get a blended yield of 9 to 10% in certain cases. But it's a good point that you're making, and I think, but it's also important to understand that there is credit risk involved. The reason why they're single A rated is because they're not as credit worthy as a State Bank of India or in fact the Government of India. So that is an important clarification. But I think we've had a very interesting conversation today, and I'm already feeling a little hungry thinking about my biryani example. Thanks so much for taking the time.
Pleasure is entirely mine, Alex. Thank you very much.
All right, hopefully I've made you a little hungry, or at least I've gotten you to think a little bit about how you want to construct your portfolio. Thanks so much for watching. Let us know what you think, and do stay tuned. This is NDTV Profit.